So tax season is upon us.
Oh, yeah. Everyone's favorite time of year, right?
Right. I mean, it is just that time when, you're gathering all your documents, you're looking back at last year's gains, and you usually realize something kind of terrifying.
That your portfolio looks absolutely nothing like what you originally planned.
Exactly. It is totally out of whack. And welcome to the deep dive, by the way. Today we are unpacking a specific, highly relevant document that outlines 5 tax-smart ways the wealthy rebalance their investment portfolios. Because, look, rebalancing is one of those chores you just know you have to do.
Right. It's essential.
But the core problem is that selling your investments to restore that balance can trigger massive capital gains taxes. So our mission today is to figure out how affluent households adjust their allocations while, limiting that tax hit and protecting their long-term returns.
Which is really the secret sauce. I mean, the overarching objective for high net worth investors is always to restore that balance, right? To manage their risk, but to execute those moves without leaking capital to the IRS. Because paying unnecessary taxes actively destroys your compounding returns over time.
Yeah, and even if you listening don't consider yourself like ultra wealthy quite yet, understanding these mechanics is basically like getting the playbook of the pros. It fundamentally changes how you view your own investments and your whole tax strategy.
It really does shift your mindset.
So let me set this up with a bit of an analogy to start.
Go for it.
Think of your portfolio kind of like a carefully landscaped garden. So over a year, some plants grow totally wild and take over, right? Like, say, a giant oak tree that represents your large cap stocks. It just shoots up.
Right, it's having a great year.
Yeah. But meanwhile, the smaller ferns down below, maybe those are your bonds or your international stocks, they get completely overshadowed and stunted. So rebalancing is basically going in and pruning back that giant oak tree so the ferns can finally get some sunlight.
I like that. But the tax hit in that scenario is like accidentally taking a shovel and severing the root system while you're trying to prune the branches.
Oh, wow.
The
Yeah,
entire ecosystem suffers. The capital you lose to taxes this year could have been generating more wealth for you next year and the year after that.
exactly. You're trying to fix the garden, but you're killing the roots. So what the wealthy have figured out is how to prune that garden without ever touching those roots.
Right.
So let's jump right into the first line of defense. Because before we even look at how to sell assets smartly, our sources point out a pretty massive thematic shift.
Yeah, the most tax smart way to rebalance is just to not sell appreciated assets in a taxable account at all.
Which sounds almost too simple, right? Like,
Yeah.
the ultimate way to sell smartly is just to not sell.
It sounds obvious, yeah, but it actually requires a lot of discipline.
Oh.
So the method they use here is directing new cash to adjust the allocations. Rather than selling off chunks of that overgrown oak tree, the wealthy often just use new money to buy more of the underperforming assets.
Wait, so instead of like draining the deep end of the pool to fill the shallow end, you're just pointing the garden hose at the shallow end until the whole thing levels out.
That is a perfect way to put it. Yes, you steer incoming cash toward the areas of the portfolio that have lagged.
Okay, but let's get into the mechanics of that because where is this garden hose getting its water from? Most people listening aren't just sitting on massive, piles of uninvested cash waiting to fix their asset allocation.
Well, you'd actually be surprised by how much cash a mature portfolio generates entirely on its own.
Really?
Yeah, we are talking about the natural exhaust of the investments. So stock dividends, bond interest payments, mutual fund capital gain distributions, plus obviously any fresh contributions you're making from your day job.
Oh, like,
But here's the thing. A very common mistake average investors make is that they set all those dividends to just automatically reinvest into the exact same assets that just paid them out.
oh, I do that.
Most people do. But think about it. If your tech stocks are already wildly overweight in your portfolio, automatically reinvesting your tech dividends just makes the imbalance even worse.
Oh, man. Yeah, you're right. You're just feeding the beast.
Exactly. So what affluent investors do is they turn off that autopilot, they pool all that exhaust cash, and they intentionally steer it toward the underweight assets.
So you're only executing buy orders?
Right. Since no assets are being sold at all, there is absolutely zero taxable event.
That is brilliant. But then we'll push back on the math here for a second.
Sure.
What if the market just goes on an absolute tear? Like your large cap stocks are up 40% in a single year, and your portfolio is wildly out of balance. That slow drip of dividends and interest from your hose just isn't going to be fast enough to help the ferns catch up to a 40% oak tree growth spurt.
And that is the natural limitation of the new cash strategy. It really is. And it's exactly where affluent investors move to their next structural advantage,
Which is?
rebalancing inside tax-advantaged accounts first. So if that incoming cash flow isn't enough, they execute the necessary trades inside accounts like their traditional IRAs, Roth IRAs, or their 401ks.
Because trading inside those accounts doesn't trigger immediate capital gains.
Exactly. You can sell a stock that, tripled in value inside a Roth IRA, use that cash to buy bonds right there in the exact same account, and the IRS doesn't hand you a 1099 for it. The friction is just gone.
Wait, okay, I have a structural question here, though.
Yeah, go ahead.
If that money is locked up in a 401k, does rebalancing there actually fix the balance of your overall wealth? Like, if my taxable brokerage account is heavily skewed toward super volatile tech stocks, and I fix the big picture map by buying a ton of bonds over my 401k, my taxable account is still incredibly risky, right?
On its own, yes, it is.
So if the tech sector crashes, I'm still feeling that pain every time I open my brokerage app.
Well, this requires a pretty massive mindset shift. Wealthy investors don't view their taxable account, their IRA, and their 401k as like three isolated buckets that each need to be perfectly balanced.
Right.
They view all of those different accounts as one giant overarching portfolio. The market doesn't care which specific login holds which asset. The return and the risk are based on your aggregate exposure.
So they use the 401k as like the shock absorber for the whole system.
Exactly. You do all the messy, heavy lifting, selling massive winners, buying the losers in that tax-free zone.
Wow. Okay, so, but what if, and let's just keep escalating this, right?
Sure.
What if your new cash O's isn't running fast enough, and your 401k is already perfectly balanced, or maybe it's just not big enough to absorb the shifts? Eventually, the music stops.
It does.
Eventually, you actually have to click sell on an appreciated asset in your taxable brokerage account.
You do. And when realizing a capital gain becomes unavoidable, we enter the realm of strategic selling.
Yeah.
And the primary defense mechanism here is harvesting losses to offset your gains.
Tax loss harvesting.
Mhm.
You hear this buzzword thrown around constantly, especially right around December.
Oh, yeah. Nonstop.
How are the pros actually executing this?
Well, it involves deliberately identifying and selling investments in your taxable account that have dropped below what you paid for them. You are purposefully realizing a loss.
Okay, so wait. Is this basically a silver lining to making a bad investment? Like you're using your mistakes to cancel out your successes?
Mathematically, yes, because the magic happens when you pair that loss with the gain you were forced to take to rebalance. The realized loss wipes out the taxable gain, basically shielding that profit from the IRS.
So if I sell 10 grand of my overgrown oak tree and trigger a gain, but I also sell some international stock that's down 10 grand, they just cancel out.
They perfectly offset. But it gets even better. If your total losses for the year actually exceed your gains, the IRS lets you take up to $3,000 of those excess losses and deduct them against your ordinary income.
Wait, my ordinary income?
Well-
Like my actual salary?
Yes.
Oh, wow.
And that is hugely valuable because ordinary income is usually taxed at a much higher rate than capital gains.
Right.
Plus, if you still have losses left over after that $3,000 deduction, you can carry them forward into future tax years indefinitely.
So you basically keep them in your back pocket.
Exactly, just waiting to offset future gains whenever you need to rebalance down the road.
Okay, but there's a major caveat here from the sources, right? Because the IRS isn't stupid.
They are very much not stupid. Which brings us to the IRS wash sale rule.
Yeah.
You cannot just sell a losing stock at, 9:59 a.m. to capture the tax break and then buy the exact same stock back at 10:01 a.m. because you still like the company.
Right, it's like the IRS is putting you in a 30-day timeout to prove you actually gave up on that stock.
That's exactly what it is, a strict 30-day window. If you buy the exact same asset or even a quote-unquote substantially identical asset within 30 days before or after the sale, the IRS completely blocks the loss deduction.
So you took the loss for nothing.
For absolutely nothing. You don't get the tax offset and you're right back where you started.
Which means you really have to map out the calendar when you're executing these trades.
Oh, calendar management is everything.
And that actually leads perfectly into the next strategy, because our sources highlight that timing isn't just about managing the losers right. It's about meticulously timing the sales of your winners, too.
Right. Because capital gains rates are entirely dictated by the calendar. Affluent investors track the holding period of every single share they purchase. If you hold an asset for 1 year or less, any profit is a short-term capital gain.
And short-term rates are brutal. I mean, that's taxed at your ordinary income rate, right?
Yep. Which for a high earner could be up around 37% federally.
Ouch. Plus state taxes.
Exactly. But if you wait just one day longer holding it for more than 1 year, the profit is classified as a long-term capital gain, which tops out at 20% for the highest brackets.
Wait, so just by waiting one extra day, the tax rate drops by almost 20 percentage points.
It is a staggering difference just for sitting on your hands.
So if I bought a stock last January, it went to the moon, and now in December, my portfolio is way too risky. I just don't touch it. I wait until January to cross that threshold.
Right. You're giving yourself a massive raise just by delaying the trade a few weeks. And wealthy households take this even further by coordinating these sales with lower income years.
Oh, interesting. Like if they know they're taking a sabbatical.
Exactly. Or a business owner who anticipates heavy write-offs next year, their overall taxable income drops, so they intentionally delay rebalancing until that specific year. They might even slip into the 0 or 15% long-term capital gains bracket.
It's basically a multi-dimensional chess game. You're balancing market risk against the timing of tax brackets.
It really is.
Okay, so let me quickly recap the playbook so far.
Sure.
We are directing new cash to avoid selling. We are hiding our messy trades inside our tax-advantaged accounts. We're actively harvesting our losing stocks to cancel out the winners. And we are obsessively watching the calendar to hit those lower long-term rates.
That's the core of it, yeah.
But there is one final strategy we have to unpack, and honestly, this one is my absolute favorite because it feels like a magic trick that somehow bypasses the tax man completely while actually helping others.
Ah, yes. The philanthropic loophole.
Yes. Talk to me about this.
So, for wealthy investors who are charitably inclined, the ultimate tax-smart way to rebalance an overweight position is to donate the appreciated stock directly to a qualified charity.
Directly transferring the shares, not selling the stock and giving them the cash.
Exactly. Direct transfer.
Let me make sure I'm getting the math on this because it is wild.
Break it down.
Okay, so you buy a stock for a little and it grows a lot, right? Say I bought it for $1,000, it grows to $10,000. If I sell it, I get taxed heavily on that $9,000 of growth. But if I donate the stock directly to a charity, I pay zero tax on the growth.
Zero capital gains tax. The taxable event simply never occurs for you.
And wait, I also get to write off the full current massive value of the stock on my income taxes.
Yep. As long as you held it for more than a year, the IRS lets you claim a charitable deduction for the current fair market value. So you write off the full $10,000 against your ordinary income.
No wonder this is a staple strategy for the wealthy. I mean, I bypass the capital gains tax entirely. I get a massive deduction that lowers my income tax, and the charity gets the full $10,000 of value.
And from the charity's perspective, it's totally frictionless. Since they are a tax-exempt entity, the moment you transfer that stock to them, they can just turn around, sell it on the open market, and they don't pay a single dime of capital gains tax either.
Wow. It's literally a win for everybody except the IRS. You cleanly cut out this overweight, risky asset from your portfolio, you restore your balance, and instead of taking a tax penalty, you are heavily rewarded.
It's the pinnacle of efficient capital allocation. Direct stock donation isn't just an afterthought for family offices. It's a primary structural tool.
That is just incredible. So when we zoom out and look at all 5 of these strategies together, what is the key takeaway here? We started with this messy, overgrown garden that desperately needed pruning.
I think the synthesis here is that, for the affluent, portfolio rebalancing is never just a mathematical exercise in getting back to a target percentage. It's not just about making a pie chart look pretty, you know?
Right. Yeah.
It is fundamentally a tax optimization exercise. Every single adjustment they make is filtered through the lens of tax efficiency.
They're trying to keep the money inside the compounding machine for as long as humanly possible.
Precisely. By harvesting losses, using those Roth IRAs for trades, redirecting dividend exhaust, managing that 1-year clock, or donating stock directly, the goal is always unified. Limit the friction, keep more of the gains working for you instead of sending a larger share to the IRS.
It is an entirely different way to play the game. Now, before we sign off, I do casually but clearly need to relay a very important editor's note from our sources.
Oh, definitely necessary.
Right, so just a reminder to you listening, this deep dive is strictly for informational and educational purposes. It does not constitute legal, tax, or financial advice. Investing always involves risk, including the possible loss of your principal. And honestly, the tax code is incredibly complex, so you should always consider your own specific circumstances and consult with a qualified professional before executing any of these strategies.
Seriously, the wash sale rule alone has caught so many unsuspecting investors off guard.
Absolutely.
Mm.
But I do want to leave you with one final kind of provocative thought to ponder.
Let's hear it.
So our sources today focused entirely on how these strategies protect individual wealth, right? But if you zoom out, think about how these tax rules actively shape the behavior of the entire stock market.
Oh, macro level.
Yeah. If millions of investors, especially the wealthiest investors and institutions who control massive amounts of capital, if they are all incentivized by the IRS to hold stocks for exactly 1 year and 1 day, or to relentlessly dump their losing stocks right before the end of December just to harvest the losses.
Which they absolutely do.
Right. So how much of the stock market's daily movement is actually driven by the true value of these companies, and how much is simply driven by the tax calendar?
Just something to think about next time you see a massive market move in December and wonder why.